Welcome back to Author's Note. Resource nationalism is a term that covers a lot of different measures, from outright expropriation to regulation and tax. It's been one of the big stories of 2012, from Argentina to Kenya to Mongolia. Here to talk about it with me today is James Smither of risk consultancy Maplecroft. James, thank you for joining us today. Now, we've put up a picture of some of the poster children, as it were, of resource nationalism. Fernandez there of Argentina, which expropriated famously YPF. But although Latin America is seen as one of the hotbeds of resource nationalism, there's something more subtle going on now, isn't there?
Yeah, absolutely. I mean, resource nationalism is a trend that we can see spreading across many different types and outcomes, as you mentioned. So not just the kind of traditional, most famous nationalisation, taking an industry or a company into national control, but also actually increasingly, I think, and this is really the trend to look out for in the year ahead, it's a trend that's moving into more subtle forms that are easier to defend for governments and much harder for companies to argue against, and they're ones centred around socio-economic development. So the redistribution of revenue through fiscal measures, increased royalties or profit taxes, or even through subtler means still, such as increasing the proportion of local procurement or the proportion of local employment that companies must have when they're extracting natural resources in these countries.
Well, let's take a look at the our map that we have today. From this, which is shows some of the higher risk areas of resource nationalism that Maplecroft have identified, it looks like it's something of an emerging markets issue. Is that still the case?
I think in the public perception and perhaps the investor perception, yes, and of course in countries where there's a lack of revenue in the exchequer and where natural resources are the quickest path to development and perhaps the most obvious investment opportunity, where oil and gas and mining companies have been going in for longest, it's a very obvious trend to look out for. But of course we mustn't forget, in the last couple of years we've also seen new taxes imposed on oil and gas and mining projects in countries like the UK, in the North Sea, in Australia with the MMRT, and are under discussion now in places like Quebec and Canada and even in the US with this discussion of a 12.5% royalty being imposed on mining in state lands. So it's not just an emerging markets phenomenon, but it tends to be most scary to investors in emerging markets where there's a lack of rule of law to provide the protections you'd look for.
And what role does the price of commodities play in all this? Obviously, when commodity prices are high, I guess people are slightly more comfortable, there's more money to go around. What happens if commodity prices, as we've seen recently, start to become more depressed?
Well, it's a very interesting balancing act, and I think, again, a trend to look out for in 2013 if we see some of the perhaps base metal prices starting to slip, as they've been showing signs of doing. But back in 2007, 2008, the Congolese government, you can see an extreme risk country here, was being very assertive in reviewing all the mining licenses. Then we had Lehman Brothers, and suddenly the copper price started to slip, and the Congolese government's position of strength in terms of the power it was able to exert with its license review slipped very dramatically, and we saw a kind of recalibration of that process as a result of the copper price slipping.
So looking forward to 2013, next year, we've identified a few high-risk countries here. Are there any that you would pick out and say these are ones to watch?
Yeah, I mean, I think all the markets we've got here that you can see in rather intimidating shades of dark red and red are what we call high risk and extreme risk, and that's really through a combination of kind of the propensity they have, through a lack of rule of law, the ability of presidents and prime ministers to act without legislative or judicial restraint. They also have resource-rich economies in many cases, but also, of course, they have a recent history of doing things that would be perceived as resource nationalism, like in Ecuador, Bolivia or Venezuela. So I think in the year ahead we can see the same kind of countries that have been exerting particularly a negative trend in this direction, like Guinea, like Zimbabwe. We can expect more of the same, but also some countries that don't perhaps attract as much headlines. You mentioned Mongolia introduction. Kazakhstan is another one, which by the end of 2012 was requiring companies to do 50% of their procurement from local Kazakh firms, a very different form of resource nationalism from expropriation. Again, those are countries to watch in the year ahead.
And there's one trend that you've pointed out as well in the past, which is resource nationalism has got a sort of sub-country element, hasn't it?
Yeah, that's a trend I think that we can certainly look out for in the years ahead, and that's really, and I was in Rio de Janeiro 2 weeks ago, in fact, and there were these big protests, 200,000 people on the streets in the centre of the city demanding a greater share for Rio province and Rio as a city from the extraction of the pre-salt oil and gas reserves offshore near Rio de Janeiro. And that sense from local communities where oil and gas projects or mining projects are concentrated, they're not getting enough of a slice of this particularly lucrative cake, when they're the ones who have to deal with the environmental impacts, perhaps the infrastructure disruption that comes with a large extractive project. As more and more countries move towards a more federal, local government empowered government system, that's going to be a new player and a new factor in the resource nationalism equation in the year ahead and beyond.
Well, James, thank you very much. So for 2013, look out for resource nationalism within countries, between companies and countries themselves, and it's going to be another big story for next year.